Let's uncover the truth of credit scores by breaking down the 5 factors that make up your credit score. Your credit score is crucial as it reflects your financial reliability to lenders, influencing your ability to secure loans, credit cards, and favorable interest rates. A good credit score can open doors to financial opportunities, while a poor score can limit access to essential financial products. Understanding your credit score. To improve your credit score, it's important that you understand the algorithm that makes up your score. So here are the 5 factors that go into your credit score. Factor number 1, inquiries. This makes up 10% of your overall score. When an individual's credit file is accessed, it results in an inquiry, with only specific inquiries related to active credit seeking, known as hard pulls or hard hits, potentially affecting the credit score. Additionally, the credit score excludes soft inquiries or soft pulls, such as pre-approved credit offers or personal requests for credit history copies, for example, using apps like Credit Karma and so forth. Factor number 2, public record. This makes up 10% of your overall score. Individuals with a previous bankruptcy record or instances of collection problems and other adverse public records may be deemed as posing a risk. The occurrence of such events can and may affect one's credit score. Factor number 3, credit history. This makes up 15% of your overall score. This segment of your credit report outlines the duration for which your credit accounts have been active. The credit score computation usually takes into account the longevity of both your oldest and most recent accounts. In broad terms, creditors prefer to observe a track record of responsible credit account management over an extended period of time. My advice in this part of your credit history is to keep old credit cards and lines of credit active. If you were to close a credit account, close the newest ones first. The longer your credit history is, the better. Factor number 4, used credit versus available credit. This makes up 30% of your credit score. The ratio of used credit versus available credit, also known as credit utilization, is a crucial component of your credit score, accounting for approximately 30% of your total score. This metric is significant because it reflects your ability to manage and handle credit responsibly. Lenders and credit bureaus view high credit utilization as a signal that an individual might be over-reliant on credit or facing financial difficulties, potentially leading to challenges in repaying debt. Consequently, maintaining low balances on your credit accounts is advisable, with a general rule of thumb being to keep your utilization below 30% of your available credit. This practice not only aids in optimizing your credit score, but also demonstrates to lenders that you can manage your credit in a disciplined and responsible manner. Factor number 5, payment history. This makes up 35% of your credit score. Your credit history encompasses the repayment details of various credit accounts, including credit cards, lines of credit, loans, and mortgages for different property types. This section not only reports on timely payments, but also includes information about late or missed payments, public records, and collections. Credit scoring models analyzing the timing, frequency, and amounts of late payments, as well as the proportion of delinquent accounts in relation to the total number of accounts on file, impacting your overall credit score. I always advise that try and make just the minimum payment. If you can't make more than that, at least your credit history shows on-time payments. How to monitor your credit score. First off, let's discuss what a hard credit check and a soft credit check is. A hard credit check, also known as a hard inquiry, occurs when a financial institution thoroughly examines your credit report as part of a lending decision. This type of check is common when you apply for significant financial products such as a mortgage, a personal loan, a credit card. Unlike a soft check, A hard inquiry can slightly lower your credit score and remains on your credit report for up to 2 years. Lenders use hard checks to assess the risk of lending to you, considering factors like your payment history and credit utilization. It's typically initiated with your permission during the application process for a new line or a credit loan. A soft credit check is a less invasive look at your credit report. It doesn't affect your credit score and it isn't linked to a specific application for new credit. You can perform a soft check by using services like Credit Karma or through your mobile banking app. These platforms access your credit report in a way that doesn't impact your score, allowing you to keep an ongoing eye on your credit health. Monitoring your credit through soft checks is crucial for several reasons. Firstly, it allows you to track your financial progress, particularly if you're working towards improving your credit score. Regular monitoring helps you see how your financial habits influence your score over time. Secondly, it's essential for catching mistakes or inconsistencies in your credit report. Errors on your credit report, which are not uncommon, can unfairly lower your score. Early detection of these mistakes means you can address them promptly with credit bureaus. Lastly, regular checks can help you spot signs of identity theft early, such as unfamiliar accounts or inquiries, enabling you to take action before serious damage is done. Overall, keeping an eye on your credit through soft checks is a proactive step in maintaining your financial health and security. Credit score ranges and their implications. 760 plus. Outstanding. Congratulations. You are considered exceptionally creditworthy, and as a result, you can expect to receive the most favorable terms, including the lowest interest rates on mortgages, loans, and lines of credit. Your credit history reflects a lengthy period of responsible credit usage, a diverse mix of credit types, consistent on-time debt repayments, and maintaining low account balances. 725 to 759. This is good. This score indicates to lenders that you generally meet your payment obligations promptly and your credit balances remain relatively modest in comparisons to their limits. You still qualify for favorable rates in most situations. The only potential limitation might be a slightly elevated balance to limit ratio, 660 to 724. This is fair. You present a moderate risk due to encountering some financial challenges, such as late payments or excessive debt. While creditors may extend a loan, it will likely come with a higher interest rate and may necessitate a deposit or collateral. Improvement efforts are needed to enhance your score. 560 to 659. This is limited. A score in this range suggests a higher risk profile, making it challenging to secure new credit. If approved for a loan, expect elevated interest rates. Factors like late payments to multiple lenders, loan defaults, collections, a past consumer proposal, or bankruptcy may have contributed to this score. Consider consulting with a credit counselor for guidance. 300 to 559. This is poor. Scores within this range face significant approval hurdles. If your credit falls here, cautious credit applications are advised. To rebuild credit, focus on reducing debt, settling accounts and collection, making timely payments, and consider transitioning to a secured credit card. Seeking assistance from a credit counselor is recommended. Best practices for good credit health. Use a credit card for everyday purchases, but pay it off. To build up your credit history, you have to use your credit card. I recommend using your credit cards for lunches, groceries, morning coffee, gas, etc. Pay it off when the bill comes in. This is good practice to build credit. If you're going to charge a large bill for a vacation or furniture, etc., plan it so that in 6 to 8 months, you pay that bill off if you can't do it immediately. Pay off your balances in full, if possible, at the end of each month. Paying off your credit card balances in full at the end of each month can have a notable impact on your credit score for several reasons. One of the most crucial factors in credit scoring models is your payment history. and consistently making on-time payments is essential for a good credit score. When you pay off your credit card balances in full and on time every month, you demonstrate responsible credit management, which can significantly enhance your payment history's positive aspects. Keep your balances under 30% of the credit limit. Keeping your card balances under 30% of your credit limit is a prudent strategy to improve and maintain a healthy credit score. This practice is closely related to your credit utilization ratio, which is a crucial factor in credit scoring models. Your credit utilization ratio represents the percentage of your available credit that you are currently using. When you keep your balances under 30% of your credit limit, it signals responsible credit management and a lower level of reliance on credit. Have more than just one line of credit. Lenders typically favor individuals who maintain at least 2 lines of credit for a minimum duration of 2 years. And there are compelling reasons behind this preference. Their primary objective is to assess your credit worthiness and determine whether you are a responsible borrower. Hopefully, this information gave you a better understanding of your credit score and has given you the tools to take action towards improving your credit if needed. If you have any questions about this video, visit my website at shopmortgages.ca. Email or call my office at rasha@shopmortgages.ca or 519-250-4848, and either myself or a senior mortgage advisor will be happy to help. Also, by commenting below, I will answer your questions and I might just do a video about it. Thanks for watching and have a great day.